Hi, welcome back to Sugar Mama Investing. Okay, it's time to get started. We are going to jump right back in and I'm going to show you just how to read the basics of an options chart. Let's jump right in. So I am in my E-Trade account right now and I have the Apple information pulled up. This is just AAPL for Apple.com or Apple.com, Apple, the company. And right now, Apple is trading for $126.58. And here's just some information about Apple and their dividend and what the stock has done for today and for the last 52 weeks. So I'm going to click on the options tab. And this is what comes up for the options chain. In my last video, I talked about what an options contract is and what are the four components of an options contract. The underlying company, which in this case it's Apple, whether you're looking to buy or sell, for what price, and by what date. So when we pull this up, we see this, and it's a lot to look at. It's very confusing, but I'll try to go through it. So at first we know it's Apple. That's the company, or what's called the underlying. Sometimes you hear it called the underlying. So at the top here, there are dates. And like I said before, options expire on Fridays. Very popular companies have weeklies. So that's what the W stands for. This is a weekly option. And the standard contract, the next standard contract that expires is January the 15th of 2021. So today is actually December the 18th, and here are the options that expire for Apple today. And so we'll just kind of go through and look at these. Right under the date, we have the December 18th, 20 options that are highlighted, and you can choose whichever week you want to look at. We're just doing some homework here. We have calls and we have puts. Now, a call option is a bullish strategy or a strategy that is positive, that you think the underlying stock price is going to go up. And a call option gives the buyer, if you buy this option, it gives you the right to buy 100 shares of stock. So that's the buy or the sell part. The buy for a call. If you want to buy 100 shares of Apple, you would buy a call. A put is an option strategy, is an option contract that gives a person the right to sell 100 shares of Apple stock. Okay, so puts are a bearish strategy, or a bearish strategy is when you are expecting the stock to go down. Okay, so call, positive, call you up, put you down. Okay, let's say that you are expecting Apple stock to go to $136. So right now it's $126. If you wanted, you can say, I would like to buy this option contract that gives me the opportunity to buy 100 shares at $126. So if you want to buy it, it will cost you 70 cents a share. If you wanted to sell it, it would cost you 66. Now, options contracts, they control 100 shares of stock. So you're not going to pay 70 cents. You're going to pay 70 cents times 100 shares, which is actually $70. So anytime you see these numbers, multiply them by 100, or really just move the decimal place over, and that would be $70 that you're going to pay. So this one, if you wanted the right to be able to buy shares at $125, would cost you $155. Okay? So let's say next week Apple shares go up to $136. Well, you bought this option that allows you to buy it at $126. So if you wanted to own those shares, that's a great deal because you paid $70 to be able to buy those shares for $10 less. Now, at Sugar Mama Investing, I don't exercise any of the options. I just want you to understand what the option is. All I'm doing in buying and selling the contracts is making money on the difference. I like to buy the contracts for lower and sell them for higher. Okay, so if I was looking to make this trade, I would make this trade to buy it at $70 and sell the options contract later for $100. Okay, so for puts, a put is right now you're thinking the stock is going to go down. So when you're selling, it's the opposite strategy. So you would like to sell high and buy the shares back low, and you get to keep the difference that you make in there. I think Apple is going to go down to $120. So I would like to buy this put for $130. And what that $130 does is it lets me sell to a random person for $130. And then when the stock goes down, I can buy the shares back in the open market for $120. And then they make the difference off that. Puts and selling first is very confusing, but you're allowed to do it. So that's what a put would be, is you would want to buy high and sell in the open market low. Just the opposite of the calls. Calls, you want to be able to buy low and sell high. So the lower you want to pay for a call, the more it costs you. Okay? The higher you want to go for a put, the more it's going to cost you. Okay? So this is what an options chain looks like. It has those 4 options items that we talked about. The underlying stock, the call, whether you would like to buy, or the puts, whether you would like to sell. The call, whether you're expecting the stock to go up, or puts, whether you're expecting the stock to go down. The dates by which you would like to have everything done. And then the strike price, or the strike, which is the price that you would like to buy or sell your shares at. The option chain shows you where you can pick your date, you can pick if you want to buy or sell, you can pick your price, and then see how much that will cost you. So in the next video, I will actually step through a trade and show you exactly how to buy a call option and how to sell a call option. But for now, thanks for watching.